Private Placement, PPO, and PPM, Due Diligence, Term Sheet, and Regulations by Jessica Castanis. First, we're going to talk about private placement offering. A private placement offering is a sale of a stock of a company to private investors without the use of public market exchanges. It also has the same result of a public sale of stock through the exchange markets. Private placement offering does not involve securities that are registered with the Securities and Exchange Commission. There are certain restrictions on the sale of the stock to a private placement offering that are not inherent in a public sale of securities. The most significant restrictions are the dollar amount of stock that may be sold and the investors to whom which the stock may be sold to. Private placement offerings will usually use the offering memorandum. I'm going to talk about that in a little bit, which is a document very similar to a prospectus. A private placement offering is very useful to small to mid-sized businesses seeking capital, since the expense incurred in a private placement offering is a fraction of that incurred in registering securities with the SEC to enable trading on the public market exchange. Some drawbacks of the private placement offering is that there are certain investor and dollar amount restrictions. Also, due to the fact that no public market for the stock offered in a private placement offering exists. The investor pool may be smaller due to a potential investor's perception that the stock may not be readily liquidated. The process of private placement offering starts with the commitment date of the private offerings is fixed generally at the date of the availability of the approved offering documents. It's an all or nothing offering, contains by its terms a fixed or defined date for the termination of the offering. That would be the termination date. A best efforts offering may have an intermediate termination period, meaning that the offering continues until the full number of securities is placed and subscribers are formally accepted by both the issuer and by a principal of the brokerage firm. A judgment must be made as to the business of a purchaser. If it is determined that a particular purchaser is not sufficiently sophisticated in a business matters to effectively evaluate the investment opportunity, then he or she must be assisted by a purchaser representative. Purchasers of a private placement securities must purchase for investment purposes and not for purposes of resale. The typical subscription documents used in private placements contained what is called investment letter language. This representation should be personally verified. Now I'm going to talk about the private placement memorandum. It's the main information document for potential investors, but also adding required and recommended details and legal language for an offering. It goes by many names: prospectus, offering circular, and others. Nothing in a PPM can be misleading, but PPM must also meet one of the major rules of securities offerings. Everything must be disclosed that a potential investor might reasonably want to know before investing. This means that if any doubt about whether to disclose something, it should be disclosed. The PPM needs to address what kind of voting rights the securities being offered have. It should also state whether the security being offered have any preferences over any of the other securities in the terms of distributions or dividends or the liquidation of the company. The PPM must describe any rights of first refusal or buyback rights the investors or the company have. Any conversion rights need to be addressed, for example, the preferred stock to common stock or for promissory notes to equity. The offerer generally will want to set a date for the end of the offering and minimum and maximum amounts for the total offering, and state what happens if the minimum is not met. The management team and their backgrounds also must be discussed. If any have prior bankruptcies or prior security violations, that will have to be disclosed, although explanations can also be provided. Still, that may make a difference as to who is on the management team. Okay, and now we're going to talk about the term sheet. It's a document which outlines the key financial and other terms of a proposed investment. Investors use a term sheet to achieve preliminary and conditional agreement to those key terms and form the basis for drafting the investment documents. With the exception of certain clauses, commonly those dealing with confidentiality, exclusivity, and sometimes costs and break fees. Provisions of a term sheet are not usually intended to be legally binding, as well as being subject to negotiation of the final legal document. The principal documents which will usually govern venture capital needed for an investment round are a subscription agreement and a shareholders agreement, although frequently these are combined into a single subscription and shareholders agreement or investment agreement. A customized constitution is also usually prepared. The provisions of the term sheet will be included in greater detail in these documents. The subscription agreement will usually contain details of the investment round, including the number and the class of shares subscribed for, payment terms and representations and warranties about the condition of the company and its assets. Some of the protective and other provisions in the shareholders agreement may be contained or repeated in the Constitution. The decision to include terms in one or both of these documents may be influenced by the company's law restrictions and also confidentiality concerns. A venture capital investment round is usually made by one venture capital firm. The more detailed the term sheet, the fewer the commercial issues which will still need to be agreed during the drafting process. The process can be complex, and working with lawyers who are familiar with venture capital transactions is recommended in order to minimize both time frame and costs. One of the first things that a term sheet does supply you with is the means to calculate your economics, although doing so can be rather involved as you can manipulate various terms to arrive at widely different ownership stakes and economic outcomes. Some companies only have common stock, and some companies are organized as LLCs, which have membership interests. These situations are sufficiently uncommon that the lawyer will either ask you to clean up these by converting to a C Corp, or you already had good reasons for this capital structure and don't need advice. However, in financing, when you may lose control of your board, this provision takes on more importance. Lastly, I'm going to be talking about due diligence. It's what the investor does to evaluate a potential investment opportunity. Investing in early stage companies could be risky. The due diligence process should select the potential winners, identifying the key risks associated with the investment, and develop a risk mitigation plan with company management as part of a potential investment. Due diligence is a rigorous process that determines whether or not the venture capital fund or other investor will invest in your company. The process involves asking and answering a series of questions to evaluate the business and legal aspects of the opportunity. Once the process is complete, the investor will use the outcomes of the process to finalize the internal approval process and complete the investment. If the venture capital acts as a lead investor in a syndicate, then they may also share the outcome of their due diligence with other investors. There are 3 stages of due diligence: screening due diligence, business due diligence, and legal due diligence. Screening is venture funds review and evaluate hundreds of business opportunities over the life of the fund and use predetermined criteria to identify which opportunities to focus on as possible investments. This allows them to flag them quickly, the ones that fit, and also indicate that they will spend more time and money evaluating. Business due diligence is the opportunity that is determined to fit the fund's investment criteria. That the deal is assigned to a junior and senior member of a team who will investigate further to determine the viability of the deal. The liability of the deal. Each firm may have a specific process, but tends to involve reviewing the management team, market potential, the product or service and the need it meets in the business model. And lastly, legal due diligence. The fund has reached the stage of moving toward a favorable decision. Their lawyer will complete a legal review. Make sure that your lawyer is prepared to answer their questions. The advisors you can choose reflect favorably on you, including your lawyer, so you do your research to find the right ones. Ask for references to determine which firm investors respect and use them themselves. Thank you for your time.